Quantitative methods of credit control. So in this lesson, we'll go through the quantitative method of credit control, which is one method of credit control, the other being qualitative. So in this section, we will take a look at quantitative methods of credit control. So here we take a look at what is bank rate policy, open market operations, and variable ratios and rates. First, we'll take a look at what is bank rate policy. So the official interest rate at which RBI rediscounts bills in particular, approved bills that are held by the commercial bank, is called the bank rate. This naturally controls the money supply, credit and inflation whenever the RBI increases the bank rate. Now, how does it work? The way it works is that whenever the RBI increases the bank rate, commercial banks will have to pay a higher rate of interest for their loans from the RBI. This increased rate is passed on to the borrowers of the bank for their loans with the commercial bank. And as a result, there will be fewer people borrowing money from commercial banks. This means naturally, borrowers will be discouraged to borrow from commercial banks. This in turn would reduce trading and business activities, which will reduce the price level and money supply in the country's economy. So that is a gist of what is bank rate policy. Next, we'll take a look at what is open market operations. Open market operations, or OMO, is the direct purchase and sale of bills and securities in the open market by the RBI. The volume of credit as a result will be controlled. Also, by selling in the money market, excess money supply with financial institutions, commercial banks and insurance companies will be absorbed by the RBI. So what happens during inflation is that the commercial banks will be encouraged to buy the securities that RBI sells in the market. The surplus cash with commercial banks will be left with fewer amounts of funds, which in turn reduces borrowing as banks cannot borrow money, and this brings down the economic activity in the country. Next is variable ratio and rates. So following ratio and rates are discussed. First being the cash reserve ratio. So cash reserve ratio is that portion of total deposits in the commercial bank that has to be left with RBI as cash reserves. So if CRR is reduced, more money will be there with the commercial banks that they lend increasing economic activities. Or they actually give that money out as loans, increasing economic activities. Next is statutory liquidity ratio. It is that portion of deposits with the banks that must be kept as liquid assets, which are in form cash, gold, approved government securities, etc. So this helps the RBI to control banks' money supplies. And finally, the rates which we discussed, which are repo rate and reverse repo rate. We briefly say repo rate is the rate at which RBI lends money to the banks or bank borrows from RBI against approved securities. And reverse repo rate is the rate at which banks lend money to RBI or RBI obtains loans from these commercial banks. So this sums up what is quantitative method of credit control. Thank you.